Chapter 5 is all about credit and loans. In this chapter, you will learn about borrowing money, your credit score, types of interest, and loan payment structure. What is credit? Credit is your reputation as a borrower of money, whether through a credit card, vehicle loan, or home loan. What's the big deal about credit? Your credit reputation is used to inform lenders how likely you are to repay loans and is measured by a score. Higher scores mean you have access to more favorable interest rates and better opportunities to borrow money. Lower scores mean less options and higher interest rates and fees. Your credit score is a numerical value based on analysis to represent your creditworthiness. Your score is based on payment history, outstanding debt, length of credit history, new credit, and the types of credit you have. Each of these factors carry a weight as shown. Credit scores range from 300 to 850. Your goal should be to have a credit score above 700. 56% of people have no idea their credit score is the most important factor in applying for a mortgage, car loan, or a new credit card. Only 58% of Americans score above 700. The national average credit score is 692. We've talked about credit scores being important, but how can we work to establish our credit? Get a credit card to use without ever exceeding your limit. Credit cards can be used to shop online, to purchase tires, or to make travel reservations. You build your credit by using a card for purchases and then paying the bill at the end of the month. Credit is the borrowing capacity of an individual or company. There may be a case where you will not have enough credit to secure your loan, so you may be asked to have a cosigner or guarantor to also sign on your loan. This allows the lender to be more confident to accept your loan request. In case you are unable to pay your debt, the lender will contact your cosigner to pay your debts. A cosigner comes with benefits and risks. A cosigner with good credit history can help you obtain better rates. If you are unable to pay the loan, however, the cosigner is liable to pay. Choosing a cosigner is a very important decision. This person is taking a risk and should be on solid ground financially. If you find a cosigner wanting to help you, take responsibility and get your loan paid off in a timely manner. Interest is a percentage of a loan balance to be paid to the lender periodically for the privilege of borrowing money. Percentages are usually given as an annual rate. Interest is additional money on top of the principal amount to be paid back to the lender. Two types of interest to investigate further are simple and compound interest. Simple interest is interest on the principal amount only. A simple interest loan example is if you borrow $100 at 5% interest for 5 years. You would have to pay back $125. Compound interest is interest on the principal and accumulated interest. A compound interest loan looks like this. You borrow $100 at 5% for 5 years, compounded annually. You would have to pay back $127.63. Interest can also be an advantage when you are earning interest in your deposit account. Banks are using your money to make loans to customers. Periodically, the bank pays you interest on your savings. You will earn interest on your original deposit amount as well as the interest you are paid. For example, you deposit $1,000 in a savings account paying a 1.5% annual interest rate. With simple interest, you would earn $15 in 1 year. If that same account paid a 1.5% annual percentage yield rate, you would earn $15.10. Making your payment is a key element of borrowing money. It has many great positive effects. Make your monthly payments. Work with your lender to make sure the payment structure is set up in a manner that will make it work best for you. Your lender will be able to show you what the payments will look like for the course of your loan. If you are able, make higher payments towards the principal amount to reduce the amount of interest that will accumulate on your loan. This will reduce the cost of your loan. Understanding interest and loan structure is a key element to making sure you are set up for financial success. Financial success is attainable. It will take discipline and some hard work. You'll need to educate yourself, find a lender, and create a personal roadmap to meet your financial goals. True or false? Credit is your reputation as a borrower of money to inform lenders how likely you are to repay loans. Your goal should be to have a credit score of 500, 700 or above, 400, or 600. True or false? A lower credit score means you have access to the most favorable interest rates and more opportunities to borrow money. The key element of borrowing money is making your payment on time, making your payment on time, making your payment on time, or all of the above.